This dashboard displays the exact state of the Bitcoin network on June 14th at block height 953,646. The data paints a picture of complete tranquility. The minimum fee rate rests at exactly 1 Satoshi. The network clears transactions effortlessly, with zero congestion. Yet, stepping away from the blockchain to look at exchange tickers for that same day reveals a completely different reality. Spot prices are violently fluctuating, dropping hundreds of dollars in a matter of minutes. This creates an immediate paradox. The underlying settlement layer is operating flawlessly, with no organic stress, yet the market is behaving as if a massive liquidation event is underway. The entities driving these massive erratic price swings aren't moving real Bitcoin across the blockchain. The true forces controlling the market right now are entirely invisible if you only monitor on-chain metrics. To find the source of the volatility, we have to look off-chain, straight into the highly leveraged, largely opaque derivative markets. This heat map illustrates derivative exposure leading up to June 21st, revealing a massive concentration of capital pooling above the current price, creating a bright horizontal band. This represents an exact target: $83.26 million of short capital trapped at the $65,000 level. This dynamic creates a phenomenon known as liquidation magnetism. When an overwhelming density of leveraged positions builds up, it generates a gravitational pull. Market makers will actively drive the spot price out of its fair value zone to sweep that exact price level. With the network's structural baseline holding firm, the accumulation of overhead leverage creates an increasingly unstable divergence between the protocol's health and the market price. Market participants are witnessing a targeted algorithmic hunt for over-leveraged capital. We can see exactly how this trap was engineered by rolling back to June 15th. Notice these early yellow and green bands resting uncomfortably close to the spot price. Traders were heavily shorting, placing their liquidation points in a dense cluster just higher. For institutional algorithms, these dense zones are immediate targets. Moving the price up slightly forces these short positions into mandatory liquidations, providing the liquidity large players need to offload their own inventory. Fast forward to June 17th. The spot price is pushed down, breaking local support, convincing retail a macro crash has started. But look at the bottom. The lower levels fade into deep purple, devoid of leveraged buyers. The downward liquidity is entirely exhausted. When there are no buyers left below, algorithms have no choice but to reverse direction and attack the heavy clusters of short sellers resting above. This brings us to the most aggressive price action of the week, June 18th. The market plunges deeply below $63,000. It's a sharp, localized drop specifically designed to look like a capitulation event. This maneuver successfully triggered widespread panic. Traders rushing to short the absolute bottom poured fresh capital into the market, taking positions on the wrong side. Now trapped, these newly opened short positions act as combustible fuel. When the price reverses, their mandatory buybacks will accelerate the upward surge. The June 18th data reveals a maneuver engineered specifically to consolidate liquidity by trapping reactive sellers. In the immediate aftermath of that drop, market sentiment collapsed. Fear indices spiked and social feeds filled with predictions of catastrophic lower lows. But the network data rejects that emotional narrative. Returning to the dashboard, the 90-day hash rate sits at 959.8 exahashes per second, proving computing power remains secure. Simultaneously, the estimated difficulty adjustment projects a 10.7% decrease, lowering the energy cost to mine a block. This combination grants mining operations immense breathing room. Their margins improve automatically, completely neutralizing the narrative that miners are under pressure to dump their treasuries. The foundational infrastructure remains mathematically secure. The panic in the spot market is an illusion, unsupported by the network itself. We can further dismantle the bear thesis by looking at the actual transactional demand. If there was a true panic, the blockchain would be flooded with emergency transfers to exchanges. Instead, the mempool holds a mere 4,330 transactions, and the median fee is perfectly flat at 2 satoshis per virtual byte. An empty mempool during high volatility indicates that large-scale holders aren't utilizing the network for settlement. Selling pressure remains strictly confined to off-chain order books. This lack of network urgency reveals purely synthetic market volatility, where derivatives outweigh actual movement. Bringing the data back to June 21st, the consequences of this week's manipulative structure become clear. Directly overhead, the thickest, brightest band of leverage hangs immediately above the active trading zone. That is the $83 million inefficiency identified earlier. It is an algorithmic anomaly, and market makers must eventually resolve it to capture liquidity. Because on-chain selling pressure has dried up entirely, the path of least resistance is sharply upward. The spot price requires very little volume to break higher. A high-probability algorithmic sweep of the $65,000 to $66,000 range is imminent, designed to trigger the cascade of liquidations resting just overhead. The behavior of Bitcoin today demonstrates a core reality. The daily fiat price is often just a shadow cast by the derivative order book. Long-term fundamental health remains anchored in block space demand, hash rate density, and the deterministic cost of clearing a transaction. To navigate these cycles accurately, you must block out the panic of the spot market and track the invisible leverage pulling the strings. The profound silence on the blockchain right now isn't a lack of interest. It is the calculated, quiet foundation required to launch the next inevitable short squeeze.